Guys, I'm really excited for today's video. There are three big things about the stock market that I've been waiting to get off my chest. So first off, I'm sure you've heard about all the hype surrounding Palantir. It has been one of the hottest stocks over the last year, maybe even the hottest one. But today, I'm going to show you something that no one else is talking about, especially on YouTube. Not just why it's going up, but what the numbers behind it actually say. Plus, JP Morgan just dropped their 2026 stock market forecast. And I have to say, I did not see this coming. Even for a bank, I was surprised. And if you stick with me to the end of this video, I'm going to walk you through one simple lesson that every investor, beginner or expert all along the gamut, needs to hear. It's the kind of thing that separates people who build real wealth from the ones who chase trends and tend to do quite poorly during bad markets. Now, I know this video is a bit of a mix, but that's how real investing works. You don't wake up and only think about one stock or one chart or one entity, whatever it is, one asset. So I'm going to give you a full plate today. Stock analysis, market forecasts, and principles. So let's get into it, and I promise that last segment will possibly change how you invest. So first off, Palantir, the stock of the year, might end up being the stock of a lot longer. Now, let's talk about Palantir because it has been on everyone's radar lately who pays attention to the internet. Whether you're on Twitter, YouTube, it doesn't matter. Over the past 2 years, Palantir stock has exploded. We're talking over 1,000% gains. And people were calling it the next big thing, the stock you had to own. Now, keep in mind, back in early 2021, the stock got to $45, and we came out and said, hey, we're interested under $5. And everybody thought we were being fudsters. There's another big YouTube guy out there who doesn't understand anything about investing. And he was saying we were wrong. It went to $583. Never pulled the trigger because it never hit my price target and is now at $170. So more power to anybody who bought it back then and is killing it now. I absolutely genuinely love it. That is no lie. It's great for you, including that YouTuber out there. But I don't want you to look at this and consider yourself right because the stock is up a lot and consider it a good buy because it's at 170 now. This is one of the lessons we need to teach on this video and every video we do from here on out. Price versus value. Smart investing. All smart investing is value investing. Now, why did people think this is the stock you had to own? Well, part of that's because of their artificial intelligence platform, what they call AIP. It gets a lot of attention. Government contracts, commercial use, commercial growth. Their US business doubled in size last year alone. Now, if that wasn't interesting, here's where things get even more interesting. Guys, the stock has taken a big hit. It is down around 18% from its recent high, and people are suddenly nervous. Isn't that interesting? The business is doing well, it's getting better, so why are people nervous? Well, this is where we get into something that nobody talks about on YouTube, but we love to talk about here, valuation. And trust me, guys, this matters a lot more than most people realize. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. They are driven by valuation in the long run. Palantir got so hot so fast that it became one of the most expensive stocks in the entire S&P 500. When I say expensive, guys, I don't mean the share price. There are lots of companies that have a higher share price than this. What I mean is valuation. This is the price you're paying. Value is what you're getting. Think about that, guys. Everyone chased it because it was going up, but nobody was asking, am I paying too much? That's why we always come back to that price versus value discussion. Just because something is popular doesn't mean it's worth it. And there's more. A lot of folks started talking about an AI bubble, and I'm not here to say whether we're in an AI bubble or not. Spoiler alert, I think we are. But when investors get overly excited and the price runs away and way ahead of value, corrections happen. We've seen this before in every market overvaluation, but we just don't know when it occurs. Michael Burry, the guy from The Big Short, he took a big short position against Palantir. That sent shockwaves through. And what did Alex Karp, the CEO, do? He's been selling shares all along. The same guy talking about how crazy Burry is, he's unloading his stocks. Guys, I believe it's still true that nobody at Palantir is a net buyer of stock. In fact, at one point, after 1 year, there wasn't a single purchase of shares by anybody at the company. They were all selling stock. So my question is, how is Burry crazy when the people running the company don't even believe in their stock? So the big question that Palantir stockholders have now is the stock run over? So let's go break it down. So guys, we have Palantir right here. There's a lot of great things about Palantir, by the way. Guys, 80% gross margin. That means every extra dollar they sell, 80 cents of it goes to the bottom line before taxes and overhead. That is huge. That means they can grow their profit by leaps and bounds just by little growth in revenue. Versus like a car company that only makes like 15% gross margin on their cars. It's a very low capital business. They don't have to invest a lot of money in the business to get high returns. Now, their current return on capital, like I was saying, is not great, 4.4%. But in the last 5 years, the average was 13%. So it's getting better. This is a great trend for Palantir. Guys, look at this growth rate. With practically no acquisitions in the last 5 years, they spent $3 million. It's M with $3 million with an M. That's it. They've grown their revenue 28% a year for the last 3 years and 31% a year for the last 5 years. All right, guys, so what we do here, what I do with my own personal investing, this is what works for me. I always start with my stock analyzer tool. And the reason being is an error I saw a lot of people making over the years was they fell in love with the company and ignored the price. So what do? I start with the price first. Is it even worth me going any further? Do I sit there and even spend any time even researching? Because here's the point. Palantir is selling for $170 a share. Let's say I do my stock analyzer tool and it says, Paul, the company's worth 20. Well, why would I go any further? It's too far away. I'm not even going to waste my time. But what if it says, no, Paul, it's worth 150 or 200? Well, I'm in the realm of possibility or undervalued. Now I need to go spend my time doing more research. So let's pull up the last time I did Palantir and let's see what assumptions I made. So guys, I did a 10-year analysis. Now I went really aggressive here, kind of to show what I thought was the story with Palantir. I did 20, 30, and 40% revenue growth for the next 10 years, every single year. That's a lot of growth, guys. Not many companies can do this, and I'm putting it as my middle assumption. It's not to say I think it's going to happen, but here it's to show the numbers. Profit margin. I did profit margin and free cash flow as the same numbers. I did 35, 45, and 55%. But as you'll notice, free cash flow has always been higher than profit margin. So I like that a lot about the company. There's a lot of great aspects of Palantir, by the way. Great balance sheet. Very little debt. Their cash can pay off their debt like that. Guys, it's hard for businesses to go bankrupt when they have very little debt. Palantir deserves that. They've made very few acquisitions, but yet their revenue growth has been 31% a year for the last 5 years and 40% for the last 1 year. Okay, what is the PE or price of free cash flow it should sell for in 10 years? I don't want you to worry about where it's at today. What I want you to remember is the average is 15 or 16. You should give a higher multiple for great companies. I think Palantir could qualify for that, especially if they continue growing and doing well 10 years from now. If it's a bad company, you go lower. So I think Palantir deserves a premium. What kind of premium? That's the hard question. This is where the individual decisions come in. I put in 18, 22, and 26. Now, people are going to be saying one of two things here. One, they're going to say, Paul, their current PE is like 150. This is way too low. If you base it on what's currently expensive, you're not understanding the process. What you're saying is cheaper means cheap. That's not the case. If I have a $500,000 house and I put it on for sale for $5 million, according to your theory, then if I lower the price to $2.5 million, it's a screaming deal. That's not the case. It's still about what does the market get. And finally, a 9% desired return. Guys, I don't want a 9% return, but I'm trying to put an intrinsic value. What's the company worth if I get the market return of 9 or 10%? I still have to put a margin of safety in there, but I'll get to that. So I hit the analyze button. The stock's currently at 170. This is my point. At my high numbers, I have 33 as a low price, 300 as the high price, middle price of 30% revenue growth of $105. It just feels very overvalued. In fact, if you bought it today and all my middle assumptions occur, you can expect about a 3.5% discounted cash flow return. That's not worth the time. When I first started investing, I didn't look at buying a stock as buying a piece of the business. But now I've realized that. And you know what's helped me even more? The stock analyzer tool. It helps me realize that I'm just paying for a future stream of cash flow. That's all you're doing when you're buying a stock. And early on, it was hard for me to grasp that. Yes, I heard Warren Buffett say it. I heard Charlie Munger say it. But it didn't click until a little bit later. You now have the benefit of having a YouTube channel to be able to watch. You have the benefit of this community. You have the benefit of everybody, the thousands of people in this community who talk this way. That's the problem that everything money solves. This is exactly why I teach on YouTube, because these are all the lessons that I wish I'd learned 25 years ago. The key part for me was to sit there and say, okay, what do I need to know to become a better investor? Well, as time went on and I made mistakes, I realized the errors of my ways. And I'm going to continue making mistakes. But along the way, the biggest one I made was thinking that a stock going up and down was me investing. It's not. It's me understanding that when I buy a stock, I'm buying a piece of a business. And if I pay a reasonable price today for that business, if the business grows 10x, my stock will likely also grow 10x. So my job is to buy good companies at great prices. Now, guys, the title here is talking about if you caught it at the right time was Palantir's run is over. Guys, I don't know when Palantir's run is going to be over. However, I'm willing to make this kind of comment. 10 years from now, my bet is that Palantir stock will be selling for less than $200 a share, even 10 years from now, while the business gets better. Because I truly believe in the long run, stocks are a weighing machine. And it's going to take some really crazy growth for Palantir to justify these really high prices. Now, while everyone's been caught up with these AI stocks like Palantir, JP Morgan just released their forecasts for 2026. And if they're right, it could make one problem in the stock market even bigger. Now, guys, JP Morgan's top stock market strategists think 2026 will be another good year for investors. The firm's equity strategy team, led by Dubravko Lakos-Buhas, set a year-end price target of 7,500 for the S&P in 2026. Now, that's about 10, 11% higher. And that's what typically banks do. They go about 10% higher the year following. I remember 25 years ago seeing a guy telling me, I'll tell you where stocks going to be next year, 8% higher. And I'm like, well, why is that? And I believed him because he was an older guy who was wealthy. And I was like, oh, he's right. He's wrong. Guys, stocks don't go up 8% a year. Over long periods of time, they do. But on any given year, they're either up 20% or down 8%. We've been in a really, really big bull market. So back to this article. This next line says that it could even go to 8,000 in the year ahead. Wow, that's a big jump. With 8,000, that's almost 17% from where we are right now. Their main argument? They think all the hype around AI, the earnings growth we've been seeing, and looser fiscal policy are enough to justify today's high prices in the market. But what's interesting is the earnings growth hasn't been seen across the board. It's been seen in a small group of companies. They're expecting earnings for S&P 500 companies to grow somewhere between 13 and 15% over the next 2 years. And they also believe that we're going to see 2 more interest rate cuts before the Fed hits pause. If inflation cools, even though interest rate cuts are a fuel for inflation, and the Fed stays dovish, they say the market could go even higher. But I want to repeat, cutting rates is only not going to cause inflation if it's in the middle of a recessionary environment, or else it's just causing more inflation. JP Morgan also mentions how companies and governments are spending heavily on AI, hoping to boost productivity and stay competitive. All very reasonable. It's helping push the markets up, though. At the same time, they're warning that the economy is becoming more K-shaped, where wealthier consumers are still spending big, but lower income consumers are struggling. Guys, who drives the economy? Is it wealthy consumers? No, it's lower income consumers. I don't mean low income. I mean lower income, middle class families and below. So to sit there and say that a few rich people are going to drive everything, it's a really tough thing for me to understand. This creates a weird mix where big companies keep doing well, but a lot of the average people are feeling left behind. And while JP Morgan is still bullish, they admit that this imbalance could lead to sudden shifts in market sentiment. They're basically saying AI is spreading fast and transforming industries, but it's also creating winners and losers, and it might widen the gap between different parts of the economy. So this is their forecast. Strong earnings, rate cuts, and AI investment could take the S&P up another 17%. Guys, we don't know what's going to happen in the short run. I have no idea where the market's getting up next year. I could not care less. My focus is, can I pay a reasonable price for the companies I want? And am I going to dollar cost average every month? And guys, I think the market's massively overvalued. And I dollar cost average into the S&P 500 every single month without fail. Am I a little more apprehensive when it comes to my individual stocks? Absolutely. But in terms of the market overall, I'm constantly buying because I want to set that thing in my head. Paul, constantly buy no matter what happens. So guys, You've seen me talk about what I think that the stock market is overvalued. I've put it in many other videos that right now, based on stock market to GDP, the S&P 500 is 129% over historical average, overvalued. Guys, what this means is if the stock is worth, the S&P is worth 1,000, it's selling for 2,280, 128% overvalued. Guys, if it goes up 17% higher and we don't see any other growth in there, even a little bit of growth, 17% higher on 2,280 is what? That's another 500 more, 2,780. That would take us, assuming there's no GDP growth, which there will be, to 178% overvalued. So with GDP growth, maybe it's 150% overvalued, 160. That's absurd, guys. Now, it's not out of the realm of possibility. We don't know what's going to happen. No one can ever predict when the bubble will burst. All I know is valuations will matter at some point. And when it does, there will be a problem in the markets that people perceive. But smart investors like you and I will look at a down market and see the opportunity. That's what's key here. Now, I promised you a lesson in principles, and earlier with Palantir, you heard me mention this a little bit. And if you've been watching this channel for a while, you probably already know where I'm going. But it's something that I just say over and over again because it's so important. If you're new here, I want you to hear this loud and clear, and I want you to repeat this till the day you die. The most important thing in investing is understanding the difference between price and value. Let me say it again. Price is what you pay, value is what you get. If you're the kind of person that wants to pay more for value, more power to you. You're going to end up losing money. If you're the kind of person who just wants to pay less than value, you're probably going to do pretty well. Too many investors, especially new ones like I was a long time ago, look at price and think, oh, it's going up, I better buy more. Or it's falling, I better sell. That's not investing. That's reacting to the short-term emotional movements of the crowd. That's gambling. What we teach here is principle-driven investing. And at the heart of it is that difference, price, value. Just because a stock costs $100 does not mean it's worth $100. It might only be worth $60. It might be worth $200. But if you buy it for $100 and it's worth $60, you might be setting yourself up for a loss, even if the company does well, or at least it might take a while until you get to even. Now, let me give you the 5 tenets of principle-driven investing that guide everything we do here. 1, we are investors, not speculators. 2, every investment is the present value of all the future cash flows it will receive. 3, if we don't understand it, we don't invest in it. 4, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And 5th, and the most important one, a great story becomes a bad investment if you pay the wrong price. So whether you're looking at Palantir or any other stock in the world, ask yourself this: what's the business worth? Am I paying less than that today? That's why we use the stock analyzer tool. It's our way of valuing the business in some fashion. Being able to value a stock means being able to value the business. Because when you learn to do this consistently, you're not just buying stocks, you're buying freedom. And that's the goal. You're buying the ability to not get worried when stocks go down. That's a freedom. That's a calm that is reserved for very few people. Now, if you want a shortcut to all those principles I just talked about, grab our principle-driven investing PDF absolutely free. It's a simple cheat sheet that you can come back to time and time again. And guess what? 2 things. It's completely free, and I still read it almost daily. So just click the link in the description and download it today, because successful investing is not about hearing something once or twice. It's about doing it over and over again. Now, if you made it this far and the idea of truly understanding the difference between price and value excites you, don't stop here. Click the video linked on your screen right now. I'm going to walk you through how I personally analyze stocks and share everything I've learned from over 20 years of investing. Thank you for your time.